Businesses, write it off if you can. Scorecard deductions are personal like expenses that might be deductible if you do it the right way. These include meals, travel, vehicle use, home office, and a few surprising ones. But the IRS rules are specific and getting it wrong can cost you. Let's break it down. All right, quick gut check. If you had to pay full price, no tax savings, no deduction, would you spend the money on that flight, that lunch, or that fancy SUV? Now, I never suggest people spend money just for the tax deductions. Like, you definitely don't want the tax tail to wag the business dog. But if you're going to spend the money anyways, let's frame it the right way. Because losing out on legitimate deductions just means you're leaving money on the table. So let's talk through the ones that might matter. Meals. Let's talk meals. Business meals are 50% deductible, but only if you follow the rules. You need to eat with a client, a prospect, or someone involved in the business. It can't be lavish, and you better write down who you met with, where, and what you talked about. And there's no deduction for eating alone. Sorry, your solo Chipotle doesn't count unless you're traveling for business. Here's the best practice. Right as you're checking out and adding the tip, take a second to jot down the relevant notes on the itemized receipt. Who you were with, what was discussed, then snap a photo of that receipt on your phone. A lot of apps let you store it digitally. QuickBooks Online, for example, has a built-in receipt capture tool. Use it, simple habit, big savings if you're ever audited. Traveling for business, that's a great deduction opportunity, but only if it's primarily for business. That means the majority of your days need to be spent on business-related activities. Here's an example. Say you're traveling Monday through Friday and you have client meetings Monday, Tuesday, and Wednesday, but you're hanging out Thursday and Friday. That might still qualify as a primarily business trip, but it's a close call. Flip that and you've got a personal trip with business excuses. Now let's talk specifics. If the trip is primarily for business, your round trip airfare is deductible, but hotel nights, only the nights tied to actual business days. Same for Ubers, meals, and any other travel costs. If you're on vacation for a few days after the meetings, those personal days are on you. No deduction for the resort just because it was attached to a business trip. And heads up, bring your spouse or kids doesn't make it a family write-off unless they're working for you in the business and there's a legitimate business reason that they have to be there. Their portion is personal. Now for cars, if you're driving for business, not commuting, but real business use, you can deduct those miles. And actually, you have two methods, mileage or actual expenses. Just track your business miles in a logbook and don't mix it up with personal drives. Now here's where it gets a little technical. Driving from home to your office, that's typically not deductible. But if you have a legitimate home office that qualifies as a principal place of business, then driving to another business location can be deductible. Also, here's a common misconception. If you're using the actual expense method, that doesn't mean you get to skip tracking mileage. The IRS requires a mileage log. Why? Because your mileage log is what determines the business use percentage of your total expenses. And since the car is a listed property, that documentation is non-negotiable. Best practice, use a mileage tracking app like MileIQ or Everlance. They run in the background and log trips automatically, which makes it a lot easier when tax time rolls around. Home office. Do you work from home? You might be able to deduct a portion of your rent, utilities, and even repairs, as long as you have an area that's exclusively and regularly used for business. Exclusive means the space is used only for business, so your dining table won't cut it. But what does regular mean? It means you use it consistently, not once in a while, not just when convenient, but as a routine part of running your business. Think daily Zoom calls, weekly client meetings, or working from there most days. If it meets these two criteria, then yes, it qualifies, and you could either use a simplified method or track your actual expenses. Either way, make sure to document everything. Work clothing and uniforms. All right, let's clear this one up. Work clothes, can you write them off? In most cases, no. As much as I love to deduct this black t-shirt I'm wearing right now, yeah, that's not gonna happen. The IRS says it's got to meet two strict criteria. First, it has to be required for your work. And second, it must not be suitable for everyday wear. Even if you don't wear it outside of work, if you could, it doesn't count. That means suits, plain polos, even most button downs, those are all out. So what is deductible? Think branded uniforms, safety gear like hard hats or steel toe boots, or professional costumes if you're on stage. And yes, branded clothing with your logo, that might qualify as a marketing expense, but it's not a uniform. And bonus, you can even deduct the cleaning costs for those qualifying items. There are other scorecard deductions too: laptops, software, phones, tech that help you run your business. If it's ordinary and necessary for your work, it's fair game. Just make sure it's not primarily personal. That new iPhone, if it's your business line, great. But if it's your TikTok scrolling device, maybe not. What makes it deductible? Ordinary, necessary, and actually for business. Here's the foundation for everything we've talked about. In order for an expense to be deductible, it has to meet three core criteria. It must be ordinary, necessary, and tied to a legitimate trade or business. Ordinary means it's common and accepted in your line of work. And here's the thing, you don't get to decide what's ordinary, your industry does. What's normal for a DJ is totally different than what's normal for a dentist. Necessary doesn't mean essential, it just means helpful and appropriate for your business. That's a pretty low bar, but the IRS expects you to be able to explain it. And finally, you've got to be running a real business. You can't deduct business expenses from a hobby. You need to show intent to make a profit, have some structure, and actually be engaged in the work. Otherwise, it's just a hobby with receipts. If you're gonna spend it anyway, bottom line, if you're gonna spend the money anyways on meals, travel, your phone, your home office, why not structure it to be deductible? Play by the rules, keep your documentation tight, and let your business do some of the heavy lifting. It's not about cheating the system, it's about understanding it. If you'd like to learn more or schedule an intro call with our firm, visit www.tandvllp.com/tax-planning. That's www.tandvllp.com/tax-planning. I'll see you next time.